Hello, everyone. Welcome to Exencial's 2023 mid-year market outlook. My name is Nick Caselli, and I've been an investment analyst here on the team for the last 3 years. I'm going to be moderating the call today. We plan on doing a 30-minute discussion followed by 30 minutes of the Q&A towards the back half. One housekeeping note is you can submit questions by using the chat box on the bottom of your Zoom screen. Please make sure to submit any questions you have, and we'll be happy to answer those towards the end of the call. Let me flip through here. So today, you're going to hear from 4 members of the investment team. Starting us off is going to be Tim Courtney, our Chief Investment Officer. Second will be Randy. He's a Senior Portfolio Manager and handles some of the equity strategies on the team. Next, we'll have Jeff Hibler. He will be doing speaking on fixed income strategy. He's also a Senior Portfolio Manager. And finally, we're going to wrap up the discussion with John Burkett, who handles the option strategies. Lastly, we're going to leave the compliance disclosures on the screen for another minute or so, and then we'll begin. All right, Tim, can you go ahead and take us away here?
Yeah, thank you, Nick. And also I wanted to add, I know some of you may have added some questions prior to this call. You sent in those questions to us. We'll also be addressing those questions at the very end. In the meantime, though, as Nick said, you can add your current questions here to the Q&A tab at the bottom of the screen. But yeah, I'll cover the general market outlook so far in the first half of 2023. Nick, if we can go to the next slide. And looking at some current market and economic dashboard numbers, if we look at the market, you know, there's really two stories being told, one of the stock market and one on the bond market. On the stock market side, you see there in terms of market volatility at the very top, we've had very low market volatility, much still within, say, a typical range, but at the lower end of that range. And coming in a year in which the market was very concerned we'd be going into a recession, that interest rates were still continuing to rise. It is a little surprising that market volatility is as low as it's been. I know John Burkett will talk a little bit more about that later when he's talking about options and options prices. But you know, the equity market is looking at things and feeling very good about the way things are working. The economy still, in many places, still has relatively strong numbers. Earnings look like they're holding up. We're about 20% into the second quarter of earnings, and they look like they're doing relatively well. And obviously, the markets have gone up, and so the equity markets are telling a very good story. The bond markets, on the other hand, are telling a little bit of a different story. You see that interest rates had fallen. We got down to about the 3.5% range on the 10-year Treasury. That's been moving up a little bit recently, closer to 4%, but it spent a lot of this last quarter at close to 3.5%. Interest rates are falling, and the yield spread on the Treasury interest rate curve, when we look at, say, the difference between the 10-year spread and, say, the 1-year or the 3-month spread, it's negative. It's about as negative as it's ever been. We're at about minus 1.6 or so on the yield spread. That is typically taken as a sign that things are getting weaker, that slowdown is coming. And you know, markets have priced in several interest rate cuts. And so the bond market and interest rate pricing seems to be saying we are slowing down. We will have a potential recession in the near term, while the stock market is really unconcerned. So there's this disconnect between a lot of the pricing that we're seeing, and it's causing confusion, but it's also not unusual based on the amount of policy changes that we've gone through over the last 3 years, from extremely accommodative and expansionary policies to some of the fastest interest rate increases that we've ever seen, and more restrictive policy, along with some banking issues that we ran into in the first quarter. So a lot of conflicting signals. One last point I'll make on this, on the market indicators here: home prices have started to come down after the huge gains they made in 2001. So that's probably getting back to more healthy levels, that prices have kind of peaked and have come down a little bit. But also what you're seeing in the home market is not a whole lot of homes for sale, because those buyers who had locked in interest rates back in 2020 and 2021 at very low rates are hesitant to move, and they're hesitant to put their home up for sale. And so you do have some restriction on the supply of new homes coming to market. And that probably means that home prices, while they have fallen, that there's going to be some kind of floor on these home prices, and they're not going to fall precipitously, as people are very hesitant to move and have to refinance at higher rates. When we look at the economic indicators, inflation, as most of you have probably seen, inflation has been coming down for most of this year. Right now, we're sitting at around 3%. That's getting close to the Fed's target of 2%, but still above it. And it's still to be seen whether or not we're going to be able to get that inflation lower as things like wages have continued to remain quite high, and the cost of labor has continued to rise. Unemployment is well below the typical range. It has been bumping up as new entrants have come back into the job market, but still well below typical range. Our GDP numbers have remained positive, even though our yield curve has been inverted for several quarters now, and that's anticipated a recession. Our GDP numbers have still remained positive. And so this recession that everyone was talking about at the beginning of the year continues to be pushed back farther and farther, and probably now most people who are forecasting a recession are now maybe forecasting, say, a first half of 2024, or maybe even a third quarter into 2024. And consumer sentiment has been quite low. It has been rising, though. That's mostly a sign that consumers are frustrated with inflation. We had gotten down to almost the lowest point we've ever seen recorded for consumer sentiment, although it's rebounded as inflation has cooled off. I say cooled off. We've still booked about a 15% inflation over the last couple of years, but 3% relative to where we were is moving in the right direction. Okay. One thing that we've also seen in markets at the first half of this year is the increasing concentration of the market cap indexes, like the S&P 500. As of just a few days ago, right around 32 or 33% of the S&P 500 was invested in the top 10 names, the largest 10 names of that index. It's the biggest, it's the largest percentage, the greatest concentration that the S&P has ever seen. We just recently surpassed the level of concentration that we hit at the end of 2021, which for the first time reached 30%, and we're now at around 32 or 33. The market could continue to become more concentrated. That could happen, although history has shown when it tends to hit these very high points of concentration. In the following 5 to 10 years, the market tends to broaden and it becomes less concentrated. That happened in the 70s after the market had concentrated up to about a 25% level. It happened in 2000 after the dot-com craze in the S&P got up to about a 27% level of concentration. It broadened. Don't know when that's going to happen. I think it's likely that we'll get a broadening of the S&P in coming years, but it could become more concentrated. In the meantime, one thing to keep note of is when the market does broaden and you see returns going to other companies besides, say, the mega cap names, you do tend to see other strategies that are not market cap weighted tend to outperform the S&P. So that's what we think is likely in the coming decade. There will be a level of broadening, and you'll see market cap weighted indexes maybe not perform as well. Another example of this would be the NASDAQ, the QQQ index, which I think they actually just did a rebalancing of the NASDAQ maybe within the last week or so, because it too had become extremely concentrated. I think it got up to over 60% of that index was in the top 10 names. They did some reweighting, some rebalancing, and I think it's a little bit lower now, but likely you will see non-market cap weighted strategies outperform in periods of broadening. Okay. Along with that concentration, we have seen valuations move in certain parts of the market. And so as of last week, who is the largest beneficiary of the market becoming more concentrated? Those large cap names, it's been the large cap growth side of the market. They've really been the largest beneficiary as the market is looking for interest rate increases to slow and potentially reverse, as the market's looking for inflation to continue to become more tame and it hopes fall below the 3% level and stay below the 3% level. The large cap growth names have been the largest movers this year. They've been the best performers. As such, they're trading at relatively high valuations compared to their average valuation over the last 20 years. The large growth space is trading at a little over a 40% premium to its average valuation. The S&P 500, which is listed there as that US large blend, is trading at about a 23% premium to its average valuation. And then the rest of the broad market asset classes, like large value, is trading at about even to where it's been valuation-wise over the last 20 years. And then all of the international trading slight discounts, between 5 and 10% discounts to its long-term average. And US mid-small, it remains by far the cheapest asset class relative to its average valuation. So if we had to look back, over the last 10 years, it's been a good decade for equity markets, especially large growth. Over the last 10 years, as of yesterday, the S&P has done about 12.5%. Seeing as how we're trading at about a 23% premium to its long-term average PE, we probably shouldn't expect a repeat of the last decade in the next decade. It's likely that those higher valuations will pull the returns lower, still positive expected returns, but probably not like what we've seen over the last decade. Okay. If we look at the operating earnings of the S&P, we had this large surge higher in 2021, and you can see that going well above the trend line at the end of 2021. That's when interest rates were zero. All the stimulus and the spending, the monetary policy, the fiscal policies were all full steam ahead. We broke the $200 barrier on the S&P 500 operating earnings. And ever since then, as monetary policy has become tightened, Fiscal policy has become slightly tighter, although there's still a lot of spending going on. It's been hard to get back to that record level of earnings that we had at the end of 21. As of now, the Standard & Poor's is estimating a $216 a year earnings as of the end of 2023. If we hit that number, I think the market will be quite happy that if we hit that, that would be a new record. But even if we come in close to 200, that's still well above the trend line and still probably would make the market happy if we could come in anywhere near that $200 level. Okay. And then I'll just wrap up by saying 2023 so far in the first half in review, we've had slowing inflation. That was expected. We've had interest rate increases slowing. I think that was also expected. But a lot of the broader growth numbers and the GDP numbers have held steadier and better than many people thought. And that's heartened the equity market. The equity market valuations have expanded, especially for the large growth stocks, as we just said. For the remainder of the year, the inverted yield curve is still implying a slowing, if not a recession. The equity market is unconcerned at the moment, but our money supply, after increasing 40% in 2020 and 2021, has now contracted about 8 or 9%. We still have some issues with the banking sector, especially regional banks. It is harder to get loans. Their lending requirements have been tightened. That probably points to some kind of slowing. And so that would be what we would expect. And, you know, with volatility, we'll hear what John has to say later about volatility, but that's at a low level. We shouldn't be surprised if that might move higher. So considerations in the environment we're in, with so many unprecedented policy changes over the last several years, I think the answer is just to remain diversified across multiple asset classes, be accommodating investors. The market right now is paying extreme premiums for certain assets. We think you should be an accommodating investor and be nice to the market and be willing to pair some of those assets, be willing to sell some of those assets to the market at these high prices. And when the market is indifferent and offering discounts, we should be accommodating and look to be buying in those areas. And then as the market is moving back and forth, trying to deal with a lot of the distortions that have been caused in markets because of the changing policies, to refrain from making any large asset allocation changes, because the timing risk of making large asset allocation changes as these distortions are working their way through markets increases. The risk of mistiming that increases. So that's my last piece, and I'll hand it over to Randy to talk about the equity markets.
Thanks, Tim, and I like your comment, be nice to the market. As long as the market's nice to us, we'll be nice to the market as well. I'm Randy Farina. I'm part of the investment equity team. I think Nick's going to pull that slide up because I just wanted to highlight who's on the equity team. Pete Trontis and I are the portfolio managers that run the in-house equity strategies. Equity PMs are the only guys, I guess, who get their pictures on the team deck. So there we are. We're supported by 3 analysts. Nick, who's the moderator on the call, as he mentioned, 3+ years at Exencial, and as an analyst, he came out of Colgate in 2020 during COVID. We also have Ben Courtney, who's been part of the firm for, I think, more than 5 years, but he only graduated college a couple of years ago. And then Justin Sell, that's a great name for the investment team. Sell, Justin just joined in June. He comes from the University of Vermont. So those are the analysts that support the equity side. Again, Pete and I run 5 in-house strategies: the core strategy, the value strategy, the international strategy, defensive equity, and the equity income strategy, all based off a common investment philosophy, which is intrinsic value. Just to quickly summarize what is intrinsic value, that's a cash flow based methodology we are forecasting future cash flows and discounting them back. We think it gives us the advantage of having time on our side, patience on our side, and the ability to really think about the business's strategic, operational, and financial metrics in a approach that allows us to not get whipsawed by the market in times of stress. As we remember last year, and you can move on to the slide, Nick. Remember last year when we had this call, I'm going to use some of the slides that I used last year. There was a lot of anxiety in the market, rightfully so. Markets were down double digits at this time when the call happened last year, and the outlook was that growth was slowing, which it has, and that a recession is likely. That's not come yet. Asset prices had corrected. Again, this was last year's, and they were getting cheaper. When I look today, as Tim ran through his slides, the S&P from a year ago is up 18%. International markets roughly same, 18%. But the growth markets are up over 20%. And what we consider value is up only 10. There's been a slant towards definitely growth and large growth, as we all know. The Fed policy was still raising rates aggressively last summer. It was no longer in the accommodative mode. I think they had done 4 rate raises at that point. But corporations were still in good health. And the question was, when we come out of the recession, what will earnings look like? As Tim mentioned, the trend line for earnings was not 200 plus, it was below that, and those were some of the issues that we were batting around in the market last year. Now, slide ahead, Nick, on what's the backdrop today. So that was last year. What's today? Today, same thing. Growth is still slowing. There is concern now more on the consumer spending side. We listened to a couple of conference calls in the last few days about airline. We own Alaska Air, down significantly today, and we own Ryanair, down the other day. They are now flagging potential slowdown in travel. The revenge travel that has happened over the last couple of years could be facing a headwind from maybe exhaustion, a couple of trips, and then you usually take a pause, but also consumer spending is squeezed by inflation. That is a fact of the matter. We have been moving out of those travel sectors, and I'll get to that when we talk about positioning. But asset prices have rallied. Tim showed you that. John will show you that. The markets now are fair value to expensive. There are definitely expensive parts of the market. And there's some value, but it's much harder a year later to find adequate asset prices, values of stocks in the market versus a year ago. Again, there's been no slowdown yet, so corporations continue to have bulletproof balance sheets. X the banks. That was a significant Q1 event when a few of the banks, given the way treasuries and fixed income instruments are held, that caused a capital shortfall that caused some of the biggest bank failures in history. That's not to be taken lightly, but X those bank areas, the most of corporate health of the balance sheets is in excellent shape. Maybe it's the decade of zero interest rates have helped, make balance sheets very pristine. And we haven't had a recession since 2008. So companies haven't had to be worried about, a significant slowdown. Remember, COVID was a very significant V-shaped recovery in most of the industries. Again, the question about when is the recession and what will the impact will be, that is something that as managers and analysts, we continue to need to stress test in the valuations and in the forecasts of our companies, but we don't know yet. Flip ahead, Nick. So what are we doing in the portfolios? I guess this was the equity outlook a year ago. We can skip to that. The markets were cheap. We thought there was some opportunities in other sectors, but where are we now? That's all that matters. Your assets are held with us at Exencial. How are we positioning the funds? What are we doing to help, achieve your long-term goals. It's not always protecting what you have, it's achieving your long-term goals. The equity markets globally are, fair value-ish. I'd say the S&P 500, given its concentration, given its exposure to a handful of stocks, Microsoft and Apple are more than 6% of the benchmark. It's concentrated into the top 10 names at 30%. They're expensive. Tech, semis, and there is an AI bubble. Sorry, but there is. I think some of the names that have been bid up are hard to justify. And I started in my career in 1999 during the dot-com bubble. I've seen this movie. The underlying structure of AI and its ability to help businesses is real. I just think we're pricing in revenues and expectations of future revenues that just haven't materialized yet. There is no real use case of AI and how it can help bolster production, or how a company can use it effectively to either cut costs or to increase revenues. It's being trialed, and companies will definitely, our own company is trying to see how it could help us do certain functions of the organization. But to say that it's transformed industries, or it will, I think we're a little ahead, and the market has priced as if it is already transforming. I think where there is value, and this points to Tim's message and the team's message of diversification. The S&P has been the only game in town the last decade. If you owned anything other than the S&P, your returns were lowered. The S&P was the best asset class to own over the last decade. As I look forward into the next decade, I would want to be more diversified. International offers value. Value stocks offer some value. Again, I'm just going to speak to the equities, which I know. But I think the S&P has reached a valuation metric that I just don't think it's cheap anymore. That could correct quickly, or it could take years with subpar returns to correct the equilibrium in the markets of value. But at the moment, I just don't think that's the most attractive portion of the asset classes that exist. There's still long-term trends for semiconductors, automation, the onshoring of more U.S. manufacturing. I just think a lot of that's fairly valued. So, our approach right now, and Pete Trontis coined this phrase, and I love it. It's patience and balance, or balance and patience, however you want to use the two words. I think at this point in the market, you have to have balance in your overall portfolio, whether it's an equity portfolio or mixed with fixed income and other assets. And then you need to be patient. I don't know. We don't know when the recession will hit. I do know that the impact that the Fed's rate cycle has yet to be felt. I actually had a client call, or I was on with an advisor speaking with a client who's in the energy industry, and he mentioned that they're doing their capital budgeting right now, and interest expense now is doubled what it was a year ago, and that takes away the ability to use your operating expenses now get eaten up by interest expense, and your capital budgeting now gets constrained by interest expense. So there will be an impact to the rate cycle that's happened. I just don't think it's been felt yet. So we're trying to be patient. We know tech has run. Everyone wants to know why we don't own NVIDIA and Tesla, and I get it. Every year there's some handful of stocks, whether they're up or down. People want to know why you own them, why you don't own them. That's fine. What I always stress to clients, advisors, and everyone, own family members, it's the overall portfolio that matters. It's the process and the discipline and the approach that matters over time. Any one year can be performance is never linear, meaning as a portfolio manager, my performance versus the benchmark or the bogey, it's not a yearly, we just consistent yearly. Over a 3 and 5 year cycle, I believe the ability and the process of the team and the approach bears fruit. So always be patient when, strategies are struggling, or when strategies are outperforming. Again, bear in mind that it's not always a linear path up. So right now, the positions, just to wrap up before I move on to Jeff, right now, we're defensive in our portfolios across the board, from our core all the way to our equity income portfolio. We have about 10% cash in each. We are buffering for an opportunity in the market that may happen in some of the growth stocks that have run up. We've sold into that. We had a growth tilt coming into the year. We have sold out of a lot of our semiconductor, a lot of our travel and growth-oriented names. And we've been buying staples and international, whether it's international staples or U.S. staples. We've been buying global healthcare. We've been buying sectors that have been in energy is another sector as well that has been left in the dust relative to tech and AI sectors year to date. Those stocks and those sectors to us are where the value is. So as Tim said, be accommodative. We sell into the strength in our tech and communication services and consumer stocks, and we buy into where people don't see value, but we do based on our methodology of intrinsic value and cash flow forecasting. We see materials, energy, healthcare, and staples as the value today. Will that pay off tomorrow, next week, next month in the portfolio? No. And that's why there's patience, and that's why the portfolio is balanced. You accommodate, you sell into where we think valuations no longer make sense. That's what we've done. That's Tim, be kind to the market. And conversely, where we're getting greedy is in sectors that no one wants to own stocks today. Again, healthcare, staples, and energy. So that's what we're doing at the portfolio. We're always available to take questions through the advisors or through some conference calls. We're always available and to discuss what we are doing in the portfolios. But I just wanted to give you the overall, kind of what we're doing right now and just wrap it up. So I've finished, and I will now turn it over to Jeff.
Thank you, Randy. Appreciate that. And with your intro earlier, again, I'm Jeff Hibbler. I co-manage the fixed income strategies with Michael Connerly. And just kind of looking here, what we've seen so far this year is that yields have traded in a broad range in the first half of the year. Very different from last year, where it was pretty much a one-way move higher. But with that range, it's been driven by whatever kind of theme has been topical in the market at that point in time. And really kind of we've seen three themes broadly affecting fixed income. One, of course, is inflation. As Tim said, it's well off the highs from last year, but yet it's still not quickly moving toward the Fed's 2% target. The labor market, it's gradually loosening up somewhat, but it still remains quite tight. And then finally, as Randy mentioned, we had banking system stress mainly in March and April. Seems to be isolated. Part of that is due to the Fed's new liquidity facility. But yet it remains to be seen if those stresses will reappear as financial conditions do continue to tighten. So with these cross currents, the 10-year Treasury is traded in roughly 100 basis point range this year. And that's actually pretty typical in any particular given year. But a little more interestingly, the 2-year Treasury is traded in roughly 150 basis point range. And I'd say, given the stage of the Fed's hiking cycle, that's a bit more than what one would expect typically. However, net, as we see on the chart, short maturity yields have moved up, yet longer maturity yields have actually fallen slightly. And I would actually characterize them as pretty flat so far. But we have the blue line is Treasury yield curve at the beginning of the year, and the green line, the yield curve as of the close last Friday. So clearly short-term yields have moved up again, along with Fed hikes, while the longer end's been a little more anchored. And so, with that move in yields, again, it's followed the Fed's hiking cycle, and which has been moderating. This year so far, they've hiked just 75 basis points after quite a torrid pace last year. And tomorrow they're having their next announcement. Another 25 basis points is effectively locked in. They are projecting another 25 basis points later this year, which is a little bit more in question. And with that, looking at kind of Fed policy overall, again, thinking that they are likely near the end of their hiking cycle, the focus is starting to shift to them maintaining a restrictive policy for an extended period of time. And they want to do that to bring inflation down to their target. But also they're trying to calibrate that with trying to, refrain from doing undue harm to the economy and achieve that elusive soft landing. So the result of that is that the Fed is in a very data dependent mode currently. It's probably not the best place to be, but that's really kind of the reality of where things are at this point in the cycle. And Nick, if you wouldn't mind going to the next chart, wanted to illustrate this. And the green line, it's the Citigroup Economic Surprise Index. So what it measures is the degree to which economic data is either being reported ahead of economist estimates or weaker than economist estimates. And as we can see, it's generally, this is over the last year, it's generally been moving higher. From 1 year ago, they were coming in well below economist estimates, negative readings. At this point, we are on the upper end of the scale where the data has been beating estimates quite a bit. Now, overall data it's been kind of moderate. There's been weakness in some areas, but nonetheless, one assumes that the market is pricing in estimates, the data is beating it. So, it's coming in better than expected. And you can see that the blue line, US Treasury 2-year yields, have been following it very closely. So other than in March and April, when they fell following banking system stresses, it's tracking the economic surprises quite closely. Again, to me, that's an indication of just how data dependent the Fed is, and conversely, the market is trading that accordingly. So, stepping back, where does this kind of lead us, and how are we looking at things for the remainder of the year? And so, as we think the Fed is likely nearing the end of their hiking cycle, but they do want to hold a restrictive policy for an extended period, certainly as long as the economy will allow. And we think that if the economy stays reasonably strong, there really is no need for them to cut. There's been pent-up demand. Possibly the economy has stronger underlying internals than expected. They're likely not going to kind of do fine-tuning cuts, even if inflation's coming down, as if they do, that could spark inflation again, and they're still trying to win back their credibility. As Tim mentioned, estimates on recession keep getting pushed out. Consensus kind of seems to be first half of next year, maybe middle to end of next year. Key thing, monetary policy works with lags. And we were actually talking this morning on our investment call that this cycle there could be evidence that the lags could even be longer this time, due to the period of low rates and both monetary and fiscal stimulus from the pandemic. And so eventually, though, as policy does eat into economic growth, we find in fixed income that those slowdowns are typically supportive of longer maturity yields. Also been, Tim highlighted yield curve inversions. Those do tend to predict recessions, as particularly when they're more deeply inverted. And the 2-year and 10-year yield curve has been now inverted for right around a year. It's always possible this time could be different. Certainly, it's a very unique period that we're coming out of from the pandemic. But to me, the burden of proof is quite high on a different outcome with this indicator. So, given the timing of these things, it is a challenge. Back to the balanced the thought that we recommend a balanced approach in fixed income and are incorporating, longer term maturities into our strategy construction, and also recommend, where appropriate, using longer term fixed income in allocations. We would also caution against solely investing what is typically a longer term fixed income allocation in very short dated securities. That diminishes the risk and hedging benefits that fixed income adds to a diversified portfolio. And at some point in the future, when the Fed does need to cut, those short-term yields fall quickly and reinvestment opportunities decline quite quickly. So just to wrap it up, overall in our strategy for fixed income, we continue focusing on managing risks in the portfolios in a volatile and tightening monetary policy environment. We continue to position the portfolios a bit more defensively, maintaining a bit higher government allocation. And we've also been increasing our weightings in issuers that we feel are more defensive, both from a cyclicality standpoint and from a quality standpoint. And this year we've added to duration somewhat in portfolios. So John, I've wrapped my comments up. I will turn it over to you for options.
Thanks, Jeff. I'm John Burkett, Senior Portfolio Manager, and I run the firm's option-based strategies. Nick, if you would move on to the next slide, please. So when we last met in December, the overall consensus on Wall Street was that we would have a tough first half. But we suggested during that call that the first half would actually be okay because inflation was likely to fall, and all of that central bank tightening would take much longer to flow through the economy. It's important to remember that despite the rapid pace of rate hikes, the Fed started very, very late this cycle. So it wasn't actually until late May that the 2-year rate got above the level of headline CPI inflation, which is unusual. So we thought that the first half would be okay, but I will say that the market outperformed my expectations by about a mile in the first half. Most of that performance was due to the extreme rally in the Magnificent Seven mega cap tech stocks. And that rally really was not fundamentally driven. There hasn't been a big change in these companies' earnings, but they were widely hated. If you can remember back to the Oct Dec Jan period, nobody loved mega cap tech then. And a lot of professional fund managers were underweight in tech relative to their benchmarks. And as retail investors started buying these stocks, those professional fund managers essentially got squeezed and had to chase that rally. So we've seen a really blistering turnaround in mega cap tech stock pricing without really any change in economic data or earnings there. It's really just been a pure change in sentiment. The economy has cooled as expected from 2021, but it is cooling more slowly than we expected so far. Part of that is just the sheer scale of stimulus that was distributed during the pandemic. Consumers are still sitting on an estimated $700 to $900 billion in extra cash savings, but that is very unevenly distributed. And the bottom 40% of Americans now actually have less cash than they did pre-COVID. So that is a headwind as the remaining savings are depleted. People are turning more towards credit cards, and that is obviously not sustainable. The other thing that has sort of kept the economy going better than expected is government spending, which continues to be fairly extreme. We've got a deficit that's projected to grow to $1.4 trillion this year. That's well over 5% of GDP, and then continuing to grow to 6% of GDP in the following 2 years. And that is relatively shocking. Normally budget deficits are something that the government runs during periods of recession and high unemployment, essentially to offset the damage to household balance sheets and incomes. But this time around, we're going into a period where we haven't even had the recession yet, and spending is just completely disconnected from reality. Now, this is clearly not sustainable in the long run, but there's nothing to prevent it from stopping in the short term either. So that's going to be a factor to watch over the next few years. And frankly, there's nobody in DC on either side of the aisle that seems to even mention deficits or balancing budgets anymore. So it's a concern no matter what the political outcome. To date, central bank rate hikes haven't appeared to bite much. We did see the four biggest bank failures in U.S. history. The Fed reacted incredibly rapidly and effectively, so there really was not much spillover damage from that so far. Now, banks are tightening their lending standards, and that will feed through the economy slowly, but it really takes time. We've had over a decade of essentially 0% interest rates and endless quantitative easing. So there's a lot of sort of easy money stored up in the economy. We've got most homeowners have locked in 2% mortgages. A lot of corporate debt doesn't mature or need to be refinanced until 2024 through 2027. So all of these things just take time to pan out. And it's important to not get confused by a big change in sentiment in the market can sort of fool you and make you think that the data have turned or that the story has changed in terms of the fundamentals. And that's really not the case yet. So I think I would echo the overall team's message of caution and a patient and balanced approach as Pete and Randy are saying. Next slide, please, Nick. The left side chart there in red is a composite of several different sentiment indicators that includes the AAII Bull Bear spread, the name exposure index, and the State Street Investor Confidence Index. I also really like the CNN fear greed indicator, but all of these kind of paint the same message. And that is, we saw the period of extreme euphoria in 2021 flip to complete despondency in 2022. And now we're right back to extreme euphoria again. So very rapid changes in investor sentiment that aren't really aligning with the real economy. The real economy and corporate earnings change much more slowly most of the time. The right chart shows the unusually strong inflows into tech funds. Again, if you're an accommodating investor, you would be inclined to fade these rapid changes in flows or sentiment because often over the short term, the market actually moves in a contrarian fashion to sentiment and positioning. And then obviously over the longer term, the market tends to follow the fundamentals like earnings. Next slide, please, Nick. No matter how you slice this up, the S&P 500 is back into fairly expensive territory. The chart that you see there shows in blue the forward price to earnings ratio of the S&P 500. So that already incorporates the next year of earnings growth that is assumed by analysts. So we're already a year into the future there. And then the red dotted line that you see is the median level. Now, there is nothing that forces the market to trade at the median level at any moment in time. The market is always swinging between wildly optimistic and horribly pessimistic. That's just the nature of any auction market. So the important thing here is to have some sort of anchoring or grounding in the fundamentals. And right now, the S&P 500, no matter how you slice it, looks relatively expensive. The mega cap tech stocks are great businesses, but the market is embedding very, very high expectations for future growth in their current prices. So in order for those stocks to outperform, not only do they need to meet those lofty growth expectations, but actually exceed them. So I would point in particular to names like Tesla or NVIDIA. Those growth expectations are so high that investors with large positions in those stocks really need to be aware of the downside risks. As Randy said, the last decade has been very kind to people who really allowed their portfolios to become concentrated in mega cap tech stocks. And there's no perfect way to time the top on that. I will say that Apple, for instance, is a $3 trillion company. It is very hard to move the needle in terms of earnings and grow above GDP when you are that big. So this top heaviness, this concentration in mega cap tech, it is a major risk for the indices. And the actual indices themselves have sort of lost a little bit of their diversification benefits. So if that continues, then it may be important to discuss with your advisor whether those actually remain suitable benchmarks. I could create an index that is made up purely of the 5 mega cap tech stocks, but it wouldn't be a suitable benchmark for most investors. Next slide, please, Nick. So the left side chart there in gray shows the misery index, which is inflation plus unemployment. So when inflation is high and unemployment is high as well, that gray line goes up, and that's a bad thing for households. And you can see that we have seen a rapid improvement year to date. Inflation has gone from its highs down to call it 3.5% in a fairly short time, and the labor market thus far remains relatively tight. Essentially, everybody who wants a job can get one. So very positive change, and I think that's reflected in consumer confidence and in that euphoria that we're seeing in equity markets. Now, the question as we move later in the cycle is whether unemployment will start to tick up and reverse that positive impact from the rapid decline in inflation. And the economic data, 2 metrics that we watch are the Conference Board Leading Index and the ISM Manufacturing Purchasing Managers Index. That's a mouthful. And those are shown on the right side panel. And you can see that those have been consistently falling since 2021. So that despite Jeff showed that the economic data have been surprising to the upside, but they've been coming in not as bad as expected. It's not that the data are coming in positive or things are going great. The economy is cooling. It's just cooling very slowly. So that's where we are in the cycle right now. In terms of volatility, Tim showed you that the VIX index, which measures S&P 500 option prices, it had been consistently stuck in a band between 20 and 30 for essentially the entirety of the post-COVID period, reflecting heightened anxiety, lots of hedging demand in markets. And since about the end of May, that has completely collapsed. There's very little demand now for protection. The option volumes are high on the call side. There's a lot of demand for speculative, short-dated upside calls, but not a lot of hedging demand. So again, that speaks to the extreme change in sentiment from very pessimistic to potentially overly optimistic at this point. So that's sort of a big overview of where we are and why we're positioning the way we are. And I will hand it back to you, Nick. Thank you.
All right, let's see here. Okay, camera on. There we go. Perfect. So we went a little bit long during our actual discussions, but we'll definitely cut out some time. Hopefully, extend this a little bit to answer a few more questions. But we'll go ahead and dive right into it right now. So well, let's start off with a little question about AI. I know, Randy, you talked about earlier in your discussion about how you think that really AI isn't a bubble. Do you see any potential value in certain segments of maybe where to invest to take advantage of an AI trade at this point?
So I did get a question too on a text from a client. Why don't we own NVIDIA? And fair question. So again, our investment process is forecasting future cash flows and discounting them back. What can and does happen is the market extrapolates near term into the future, whether it's a 2022 when everything's down, it takes the lowest point of data and drives it into the ground, and you get cheap stocks. And if you think the forecast ends up coming out to what you think it is, you can find some opportunities. And conversely, when markets get over enthusiastic, they are pricing a unrealistic future cash flow profile for a company. Again, I started in .com, having gone through that was the best investment education you could ever get. Microsoft back in 1999 was the largest tech company in the world, largest market cap company in the world. It took 17 years, as much success as Microsoft has had with their phenomenal platform of Office and now into the cloud and really driving growth through their Azure segment. It took 17 years for the stock price to get back to what it traded at in 1999. There was a set of unfair or unreasonable expectations for the cash flow growth into the future back in 1999 on Microsoft. That is NVIDIA today, in my opinion. What is required for NVIDIA to justify its valuation today in terms of revenues, margins, and cash flow, to me, is just too much GPU. That's what they sell, a graphic process controller, processing unit. It's just pricing in, again, an AI usage and adoption that is still in its infancy in terms of just testing to see what it is. And again, back to 99, there was a company called Sun Microsystems that made servers that drove the internet. You needed a Sun Microsystems server to access the internet and to have all your e-commerce, if you were a company, up on the internet. Again, the demand that materialized was quick, but then faded quickly as companies figured out how to adopt e-commerce, how to roll it out, how to use it, and that Sun Microsystems just got too expensive, and the company over time ended up selling out to IBM back in 2010, but it was a fraction of what it was at the peak. So markets bubble. Whether we own it or not, we're going to use our same cash flow discipline, and at this point, NVIDIA to us isn't something that feels like a significant risk reward skew that's favorable for the portfolio, so we don't own it. Long answer, but we're getting a lot of questions. And this is the opposite of last year, when every question was about anxiety. Should I take my money out of the market? Why do I have an S&P 500? Why do I own equities? And again, we always stress, as a long-term component of your overall financial plan, you certainly need equities. And at certain stress points, I know it's easy to want to sell, but that is the opposite of usually what you should be doing. This is the opposite, I think, and somewhat of greed on a few stocks. I think unrealistic expectations are being priced into those stocks, and I would just avoid them. That's how we run the portfolios. Time will judge how we do.
Thank you, Randy. So I guess we'll pivot more so towards like a geopolitical point of view and how it relates to the markets. And since COVID, we've sort of seen a trend towards deglobalization with the war in Russia and Ukraine, and we're seeing some more regulations, especially some more conflict going on. I guess, John, usually you do a great job of handling these types of questions. How do you think the trend towards deglobalization has been showing itself in the markets?
Yeah, I would say that it's not deglobalization so much as it is moving away from China, quite frankly. That's really the big theme that we're seeing. Companies are starting to realize the risks of doing business there, and it's challenging because it's a huge market. So companies want to be exposed to that growth potential, the manufacturing expertise, the market potential. They want to be exposed to that, but they have proven themselves to be so investor unfriendly over the last few years that it's a real challenge. And from a geopolitical perspective, tensions over Taiwan and environmental issues, human rights issues, trade issues, there's all of these conflicts with China, and we really have not, seen a significant de-escalation. So anyone who is prudent or thinking ahead is trying to move manufacturing or diversify their base. Apple has not really done a great job of that over the last few years, but even they now are finally being dragged kicking and screaming into diversifying their manufacturing base out of China. And I think that is, it's still very early days yet on that trend. Taiwan Semi actually announced that they're putting on pause their US factory now. So the rising cost of capital and some supply issues on the commodity front are sort of offsetting that so far. But I think that will continue to be a theme for many years to come.
I appreciate that. So I guess we'll pivot a little bit into some of the rate environments and talking about cash. And I guess we could have two perspectives on this one from bond portfolio perspective and equity portfolio perspective. But has the strategic decision to leave a certain amount of cash in a portfolio changed with the rise in rates and the more value you can get out of, I guess, holding money markets and things like that?
I'll just address it first from the fixed income side. Overall in our fixed income strategy, we're not holding, high levels of cash, if you will, other than for, distributions and kind of your typical cash needs. We've kind of, as I mentioned, generally we've been wanting to extend durations out the yield curve. We think yields are at relatively attractive levels, and kind of earlier, a few years ago, during when yields were much lower, we did have a shorter duration, so had more in shorter maturities, and as those bonds have been maturing and cash has been available for reinvestment, particularly over the last year and a half, we've been able to take advantage of higher yields and extend those out the yield curve somewhat. So we like that. In some cases it does make sense to hold some cash or some short-term securities. Maybe clients have higher liquidity needs. They may have upcoming cash flow needs, which it always is prudent to hold those in shorter securities. There may also be asset allocation shifts or some other kind of uncertain points where holding it is attractive. But again, as I mentioned earlier, not wanting to concentrate everything in the short end.
Let me just jump in, answer on the equity side. Again, we are about 10% cash. That is a function of valuations in the market and opportunities that we're waiting for. I did get a question, just kind of follows that, and also a little bit more on some of the tech stocks. We do own some semiconductor stocks. Are we as worried or as skeptical about their future outlook as we are about NVIDIA? Again, NVIDIA is a dominant player in its market and has won the GPU market. I've owned NVIDIA and a bunch of portfolios I've run over the years. Used to just be a graphics chip card company for gamers that then it evolved into the cloud developed, and they found that GPUs are a better source of data processing than a CPU, which is why Intel has really lost its moat in the last decade and has continued to struggle to reinvent itself. It never figured out how to make a GPU. Not trying to go too deep on semis here, but there's equipment side of it, ASML and Lam and Clack, and of those names, I think those names are equally unattractive today. They're all phenomenal businesses. NVIDIA is very unattractive. I think a lot of the semiconductor names are about fair value today, and we've been selling into it. Why we're keeping the cash is the markets are not linear. There will be a correction at some point. Semis are very volatile. They always have a correction. We are waiting for that. We know what we want to buy. That's why we have our analysts and Pete and I develop forecasts of cash flows on businesses, so we know what the target price is. When we see something and the opportunity presents itself, we will buy it. We're waiting for Lam, Clack, ASML is about fairly valued. So there are opportunities. We own STM, Qualcomm. So there are semis that are very attractive, tied to automotive growth rate. As you get in your car today, safety content and all the electronics have definitely improved as EVs roll out. That's more content. We want to be tied to things that are with growth, but have valuation support. So if we're wrong, there's a margin of safety. Some stocks today just don't have a margin of safety, and so we don't own them. So just again, the cash will be used to buy those stocks that at some point will become attractive because the markets cycle through sectors and names, and we'll get an opportunity to deploy that cash, hopefully into some of the cheap tech stocks that we're looking at.
Before we move on to the next question, Nick, I just wanted to make one point about cash. when you're thinking about the role of cash in a portfolio, other than the obvious need for short-term liquidity, there's two things to think about. Number one is the carry on cash, which obviously is elevated right now at 5%. And to put that in perspective, the earnings yield on the NASDAQ is less than 3%. So that's just the earnings divided by the price of the index is less than 3% versus cash. So that's one dimension. And then the second dimension is market volatility. So when the market is more volatile, cash itself has a greater option value. There's a chance that you will be able to buy at much cheaper prices. So that's important to think about in terms of the role of cash in a portfolio. Typically, when market volatility is higher, there's higher chances that you're going to get a better entry point in the future.
And Ray, do you have any outlook on the telecom sector today?
In general, it's a low growth sector, whether it's wireless or wireline, it's under threat, basically from lower growth. They're high dividend yielding stocks, so they can be attractive from that standpoint. We own a few of them in the equity income fund. That they could be washed out here. Verizon and T-Mobile and even some of the cable guys have really suffered over the last 12 months post-COVID. The work at home kind of pulled forward demand, and growth looked like it was above trend. Investors own them thinking that they could sustain that, and then that's kind of unwound. They're probably attractive here, but they serve a purpose in some of the portfolios. We don't own Core doesn't own Verizon or AT&T, but they are owned in equity income. International owns Deutsche Telekom. So there's value there for sure. They've been ignored and sold off with the AI large cap tech Magnificent Seven growth of 2023. So there's definitely value there. We own them across the complex.
John, I think this would be going for you as well. Is there a consensus viewpoint on the current state of the U.S. consumer? I know we've had the U.S. consumer be resilient in the face of rising prices up to this point. Currently, where do you think we're at this point in time?
Yeah, my sense here is that, during the pandemic period, people got a taste of sort of excess spending and found that they liked it quite a bit. No big surprise there. So, as long as the labor market remains strong, I don't know that we're necessarily going to see a major pullback. Obviously, the exhaustion of pandemic stimulus is going to be a factor. The potential restart of student loan repayments in the fall is going to be a factor. But overall, I think that it's going to take, job losses and rising unemployment to really put a dent in the consumer.
Okay, I think how much longer you guys think we want to go over here? I think we're getting close.
Let me jump in one more just on NVIDIA. It seems to be the topic du jour. Good question. Why didn't you own it at 120? Fair question. Our valuation target was probably about 200 and remains 200 on it. But at that point, when it hit 122, and rightfully so, you called out the November lows, Meta was 80, Amazon was 75. There were STM, I think, was 30. There were plenty of stocks that we actually added to or continued to own. So it has to be taken in the context of the portfolio. Yes, I missed NVIDIA. 100%, I own it. Now, I probably would have sold it around 220, 240. We like to scale into positions and scale up. So sometimes we do let them ride beyond fair value. We could say we're doing that with a few names today. That's how the process is developed over time. You try not to be emotional. So having a scaling in and scaling out of positions can control your emotions. We could have bought NVIDIA, but at that time, there was equally a number of attractive stocks. We chose those. Those are up strong. Again, performance is fine year to date across most of the portfolios. Having NVIDIA certainly would have helped. Now, the last leg up, 240 to 500 on NVIDIA, yeah, everyone would have loved to have got that, but that doesn't necessarily mean that that's the right price. So over time, yeah, I would have liked to have owned it and kept it and then sold it at 500, picked the peak. But we will find out as time goes on if the market's price strike price in summer of 23 was right for NVIDIA. Just like a lot of the strike prices for tech stocks last fall was not correct. You can have the opposite where they're just overvalued, and you have to be comfortable missing, not owning. As a portfolio manager, I'm not speaking as a client here, as a portfolio manager running a process, running a team of analysts that develop ideas into a fund. It's okay to miss things. What matters is the overall portfolio, all the stocks that you own and not one individual stock. Last year, it was, why did you own Meta? Why did you own Meta? Why wasn't there stop loss on Meta? And all fair criticisms and critiques. You know, I love this job, and it's the easiest job to Monday morning quarterback, 100%. I do it on sports. It's the same analogy. What did you do that for when you could have done this? Hey, that happens. But again, have to have a process and a confidence and a discipline to just focus on what you can control. I can't control the price of NVIDIA. If it's overvalued, it's overvalued. I have to wait it out. But we have plenty of other stocks that are giving us return and accomplishing what we want for the portfolio. So that's how we think about it as a holistic view, and we don't obsess or focus on one stock, because that is not what over the next 5 and 10 years, when you look back on, if you hold international value or core, it will not be driven by one stock, I promise you.
If I could, sorry, go ahead, Tim.
John, after John, after you wrap up your answer, John, Nick, if maybe we could take one more question, and then we'll wrap up. And any questions that we haven't addressed but that we've gotten, we'll make sure to get back to the advisors and back to the people who asked those questions.
Yeah, I just wanted to make a point. You know, I'm obviously monitoring the client questions in the chat. And, you know, if a stock becomes expensive and we don't buy it because it's expensive, and then it triples in price and becomes incredibly expensive, that is the sort of thing that a momentum strategy might do. But we're not running a momentum strategy, right? We're running a strategy that's tied to fundamental intrinsic value. So, you know, it wouldn't be appropriate to buy a stock that is expensive in the expectation that it will simply get more expensive. That's the sort of the logic that a lot of Bitcoin folks use, the greater fool theory. And, you know, momentum is a perfectly valid approach. It can make money, but it is not necessarily what we do.
All right, and I guess we'll have one last question involving the banking crisis that occurred with the 3 largest banks failing. Has that changed the path for the Fed going forward? If there's still a risk out there of further banks struggling, is there any changes that you believe that need to make to their models moving forward? That's just
I can jump in on that regarding the Fed. Excuse me. You know, I do think that certainly in the wake of that, it did change their path, at least for a temporary time period. You know, I think Powell, he had congressional testimony of like the week before it, I think, and you know, was quite hawkish. Markets were expecting 2 or 3 more hikes, and then that hit. So a lot of it, as I mentioned earlier, the liquidity facilities seem to be really helping the banks with that, with the ones with problem loans. And then the question is, how does that affect credit conditions going forward? You know, we've seen tightening in credit conditions. There's something called the Senior Loan Officer Opinion Survey that the Fed sends out to the biggest banks. And you know, they've been tightening credit standards and making it a little more difficult for borrowers to get a loan. Again, that takes time. That's part of the whole financial conditions tightening process that the Fed is going through. So now that we've kind of gotten through that, things seem to be a little more stable from that banking stress standpoint. You know, the economy has been resilient. We're, you know, pricing in a hike for tomorrow and possibly one later this year. But it's kind of, it's an incremental effect over time. I think at the end of the day, it probably keeps the Fed, maybe it takes a hike or two off the table, depending how far it goes. But it's an incremental thing that is to be monitored from my standpoint.
Thank you, Jeff. That I think that's about going to wrap it up for us and the mid-year outlook. Thank you very much for everybody that was willing to take the time. I know we ran a little bit late, but I appreciate everybody hanging in there. And yeah, thank you for your time. Hopefully we will answer any questions that we haven't already that were sent to us prior. And we will email those out and talk to the advisors for the people that sent them. So we will get back. We'll make sure we answer the rest of the questions. And thank you very much for everybody's time. Much appreciated.